Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, 23rd of June. Technology stocks are facing renewed scrutiny as concerns resurface over excessive AI spending, rising debt financing, and stretched valuations. Meanwhile, European stocks stopped underperforming their technology-heavy US peers in the month of June as falling oil prices ease inflation concerns for the euro area, soften the European Central Bank expectations, and improve the outlook for the region, also helping investors diversify away from AI in a setup where both equity and corporate bonds are increasingly running on AI spending. So we will talk about that and Britain's new leadership. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So oil prices continue to fall on the back of encouraging news regarding the peace deal that the US and Iran are trying to engineer together. Encouraging in the sense that Iran says that they have made major progress during the negotiations of the past few days. As a result, US crude slipped below its 200-day moving average yesterday, that's near $74.80 per barrel level, and continues to extend losses below this level this morning. The latter decline in oil prices pulled the European yields lower yesterday on expectation that a sustainable decline in energy prices should tame inflationary pressures in the euro area and the need for more ECB tightening. Indeed, the ECB chief Christine Lagarde also said yesterday that the euro area inflation is expected to return toward the 2% policy target in the medium run, somehow tempering the fears that the European Central Bank would be entering a fresh policy tightening cycle that would hurt the growth outlook for the region. Now, ECB is still expected to hike its interest rates one more time before this year ends, but that's already priced in. So the euro dollar fell to the lowest levels in more than 3 months in yesterday's trading session on the back of this growing divergence between a more hawkish Fed, with its new chair, Mr. Kevin Warsh, determined to bring US inflation back to the 2% target, and softening ECB expectations thanks to the falling oil prices as the dust in the Middle East seem to be settling. The Stoxx 600 index is now willing to extend its gains to fresh all-time high levels, and the latter could be possible as the technology appetite is wobbling. Because the week started on strong footage for the Asian technology indices, but Nasdaq 100 failed to hold on to that optimism. The index was pulled lower yesterday by big technology stocks as news that SpaceX, which is not yet in the index by the way, said that it was looking to borrow up to $20 billion via a bond sell-off. Investment grade bond sell-off, by the way, quite unusual for a company that's burning cash. But seemingly, the recent IPO did not suffice to assuage the company's funding needs to tell how much money will be burned on the way to Mars. So SpaceX share fell more than 16% yesterday on the news, dwarfing the post-IPO rally to less than 15%, where 15% gain on the IPO's price is already huge given that the company's valuation remains massive in terms of traditional metrics like price to earnings ratio, price to sales ratio, and so on. Again, SpaceX is not yet part of the Nasdaq indices, but the fact that it's jumping on the bond train to fund excessive AI and infrastructure spending fuels early year worries about the big technology spending too much on AI infrastructure and that their spending is increasingly financed by debt. In that matter, Morgan Stanley, for example, expects the global AI-related borrowing to surpass $500 billion this year, meaning that the corporate bond indices are increasingly dominated by AI theme as well. That's why a regional thematic diversification could perform better when technology worries rise at a time valuations are sky high and debt is rising. Now remember, I was saying a few weeks ago that the European stocks would become interesting once the Middle East dust settles and once oil prices start falling sustainably. It seems today that we are getting to that point. Indeed, the Stoxx 600 stopped underperforming the S&P 500 this month in June, along with falling oil prices. And the hawkish shift in Fed's policy and rising US yields could further back this rotation from technology-heavy US to technology-poor and more cyclical European indices. I would, however, watch the US dollar's appreciation that could jeopardize part of the declining energy prices for the Europeans. But for now, the path is quite clear for further catch-up from the European stocks on their US peers and deeper downside correction in the technology-heavy indices, including the US and Asia's technology-heavy indices. Kospi index is down by more than 8% at the time I'm talking here. We just had the news that the trading there was halted due to a massive sell-off. Now back to Europe and yields. Gilt yields in the UK fell yesterday after the resignation of Keir Starmer, who handed over to Andy Burnham. Burnham will be taking the reins of the country in September and is now putting together his new cabinet, one that would ideally please gilt investors by including figures who favor fiscal discipline in the country running on rising debt and facing a declining appetite from investors to lend money to an economy marked by Brexit, a pandemic, two energy crises, and some spectacular fiscal policy mistakes, the most memorable one being Liz Truss' mini budget crisis, which actually forced the Bank of England to step in to prevent a meltdown in the UK's whole pension system. And today is an important day because it marks the 10th anniversary of the Brexit referendum. UK's borrowing costs have gone through the roof over the past decade. The 10-year gilt yield stood near 1% level on the 23rd of June 2016, 10 years ago. Yesterday, it closed near the 4.80% level. As such, the UK government now spends roughly 8 to 9% of its revenues on interest payments. Growth is bleak, productivity is declining, and despite Brexit, immigration has remained elevated. And worse, the composition of migration has changed with fewer high-earning European workers that were sent home and a larger share, naturally, of lower-income migrants, raising concerns about tax revenues and the long-term sustainability of public finances in the UK, on top of weak productivity growth. To make matters worse, the UK government seems determined today to ensure that the last profitable businesses there leave the country after being subject to ever higher tax burdens. And I'm looking particularly at the North Sea oil and gas sector here, where repeated windfall taxes have raised serious questions about the UK's attractiveness as a place to invest and do business. So all in all, 10 years after the Brexit referendum, Brexit still remains a powerful reminder that political slogans are easy, but rebuilding growth, productivity, and public finances is much harder. Again, gilts gained yesterday after the resignation of Keir Starmer, which shortened the period of leadership uncertainty in the UK, but the composition of Mr. Burnham's new cabinet will keep gilt traders busy in the coming months because the government's maneuver margin is so narrow today, and UK bondholders' patience is running so thin that whoever comes to the office must make sure that the prosperity comes from improved productivity and growth than more spending on unsustainable debt. As per sterling, I expect the downside pressure to prevail on the back of the political uncertainties into this fall. Cable has rebounded from the 132 level, which is a critical Fibonacci support for the second time this year, once in April and once in June. But falling below this level will send the pair to the medium-term bearish consolidation zone and will certainly encourage a deeper pullback toward the 130 psychological mark. That's my base case scenario, unless Andy Burnham comes with a magical recipe that would turn around things for the UK and make UK great again. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.